Nice to see you, ladies.
Hi, everybody.
Okay, so we're a minute past, and I think that although there's a few people still coming through the waiting room, I think we'll get on with the introductions. My name's Sam. I'm the founder of Women's Wealth, and fueled on HRT, I'm on a mission to improve the way finance shows up for female investors and for financial planners, to be honest. I think we've been a bit neglected by the finance profession and industry. So we're trying to make a bit of a difference here at Women's Wealth. I'm also a columnist for the Telegraph, 30 years in profession, and a fellow of the Personal Finance Society, a chartered financial planner. So I've got the kind of background and the credentials, and I'm joined by Selina Flavius, who has got youth on her side. She's the author of a book called Black Girl Finance and a very experienced coach. So welcome, Selina, and thank you for helping me with this subject.
Hi. Thanks, Sam. Thanks for the introduction. Hello, everyone. Let us know in the chat where you are joining from, and say hello.
It's nice to see a good group of ladies joining us. Right, okay, I'm just going to do a little bit of housekeeping. Anyone who joins this webinar gets free lifelong access to our network, the Women's Wealth Network, a free Enable membership. So do join. Carolyn's going to pop the link in the chat for you. There's also a download. So if you join the network and find this course when it's published later on today, there's a download that goes with it that you can help yourself to, which will support the things that we're going through today and give you another opportunity just to visit the information. Our chosen subject today is ESG, which stands for Environmental, Social and Governance Investing. Socially responsible investing is another term for it, and what you need to know. So if it's of interest to you that when you invest, you do so with an eye for the planet and the people who inhabit it, then this webinar is going to give you some good practical tips on how to navigate that space and make choices. I'm going to ask Selina really to start us off by explaining a little bit about socially responsible investing. What is it? How you do it? Would you mind, Selina, covering that for us?
Yeah, absolutely. So yes, I just want to point out lots of names for it there. So socially responsible investing, ESG investing, ethical investing. It all kind of falls under this the similar kind of band and umbrella with slight differences. But what it means is doing well by doing good. And I just want to emphasize the doing well part because obviously, as investors, whether or not you are already investing or have joined Women's Wealth to start investing, we are always investing because we want to earn a return above inflation. So that's really important to not lose sight of. But also, we have the opportunity with ethical investing, sustainable investing, ESG, the opportunity to invest and also do good with our investments. So it's a growing area in finance where people are not only looking to make money, but also to make a difference. And that can be protecting the environment, promoting human rights, or avoiding harmful industries. So, ethical investing is about aligning our money with our values, and there are different approaches to doing that, which we'll get into, as we go on, continue on with this webinar.
Thank you for that. Are there any examples you can give us of what a good investment looks like and a bad one, Selina?
Yeah, absolutely. So one of the things that we are going to talk about is something called greenwashing, and I'll go into a bit more detail about that shortly. But essentially, there are some businesses that we know when we come across them out of the gate that they are doing things that are good for the environment. So, for example, when the company Tesla came out, they are disrupting the industry, going from petrol guzzling, diesel guzzling cars, moving it into electric. So moving us into electric. So you know, a product and doing things that we continue to love to do and continue to do. So driving and transportation, but doing it in a green way. So Tesla is an example of a business that came out of the bat that was for good. And then also other companies that you may see. So, some of these kind of energy companies, so Shell, BP, they are also transitioning into, renewable energy sources in order to, be in line with this trend of, um, you know, being good with our kind of for investors essentially. But equally on the flip side, obviously if we look at Tesla right now, um, not to talk politics, but they are being impacted. Some of the decisions being made by, the Tesla founder, Elon Musk, are quite questionable. So we are in that uncomfortable situation where we know that their business and business practice and principles started off as good, but we know that there are some other sides of the practice that don't seem to be very good.
Some doubts, isn't there, Selina, around the kind of impact on other minerals of the earth. So it might not be that they're guzzling fossil fuels,
Yeah,
but they are using other minerals to quite excessive amounts in batteries. And there's
yeah,
not much around how to dispose of batteries safely and environmentally in an environmentally friendly way either. So the
yeah.
kind of that there's new problems with the new technologies, aren't there?
Yeah, absolutely. So things going for good, things kind of moving on in a positive direction. Sometimes it does, like you said, cause new problems, essentially. So I think talking about Tesla is an example of, where things are not completely black and white, not completely cut and dry. And I know that when you and I have spoken about this before going live, Sam, we spoke about, investors have to be careful that, you know, not making decisions based on expecting things to be absolutely perfect. And sometimes we have to settle for sort of okay. There has to be a bit of a compromise just because we are in this kind of grey area where businesses are transitioning, where the demands for ethical investing or being an ethical business is great, but actually we are in a bit of a transition. It's hard to just, tell a fund, an investment fund to just change to green overnight. So we may have to kind of compromise there a little bit.
And it's quite a new area in terms of, I mean, I know it didn't all start yesterday. It's been around for decades, but it's becoming more and more popular and there's more and more money involved and there's more and
Yeah,
more emphasis on the
yeah,
fact that, we can all get as rich as we like, but if we haven't got a planet to live on, we're not going
yeah,
to find
what's the
very
point?
many fun ways of spending it. So
Yeah,
like people are
exactly.
getting more interested, aren't they, in the future of our planet and how we're treating people, and they want to apply their money towards and supporting these better companies. And there is a whole kind of taxonomy, a whole language being born around it, and there's a whole set of reporting standards that get
Yeah,
tougher every year and are being applied to companies so that it becomes clearer and clearer who's in what camp, doing what and for what reasons, how they're being measured and how they're doing against those measurements. So it's getting better, the data's getting better. But there is this danger at the moment of funds trying to set that up for the right purpose. And then, one bad press article makes them look like liars when
yeah,
actually the standards are developing and many funds have great intentions and they are committed to good, but sometimes the supply chain isn't checked out as well as it should be, or for commercial reasons something gets in that should have been excluded. Perfection comes at a massive price. What we're aiming for is good enough, really, I think,
yeah.
so that investors can support good funds that are doing good things out there, but without it costing so much that nobody can afford to invest in them. So that's the balance I think they're trying to get right out there at the moment.
Yeah, absolutely. And I'm going to talk a little bit about some of the FCA rules that we need to be considering when it comes to investing. I did also want to talk about just briefly, and let me know in the comments if you have heard about greenwashing, which is used to describe the practice of companies launching adverts, campaigns, products, etc., under the pretense that they are environmentally beneficial. And sometimes it's in contradiction to their environmental and sustainable records in general. So definitely something to consider when you are looking to invest in an ethical way. And the FCA have come out with labeling and something called the sustainability disclosure requirements in response to greenwashing and firms misrepresenting their products as environmentally friendly. So they do things like, they've got an anti-greenwashing rule, which is to make sure that authorized firms who are offering ethical funds. It must be very clear, fair, clear, and not misleading in terms of how they are applying the new rules to products. And then they also are doing something called sustainable investment labels. So um, you know, and I'm not going to go into all of the detail because we'll be here forever if we're trying to understand what it all means. But it's just to showcase that actually it may, on the surface, it may seem really easy to pick a kind of ethical fund, but actually it's not. And I just wanted to ask you, Sam, how does women's wealth, how are we helping our clients to select the best funds, to manage this requirement to invest in an ethical way? And do you have any examples of some of our clients as well?
Yeah. I mean, I think importantly, there are three areas for consideration if you're thinking about investing with an ethical screen, and that is cost, diversity, and performance. And I'm going to start, I think, with cost, because I think it's the one thing that you do have to accept, really. The evidence that I'm very much a data and evidence driven person. And most of the recommendations we make, I can point to a shed load of data which backs up why we say the things we do. And I'm just going to share a slide with you here from one of the discretionary fund managers that we use. Can you see that?
Yeah, I can see. Yeah.
So this is from Timeline. Timeline's one of the discretionary fund managers we recommend in the ESG space. And they're saying about costs, they're saying that actually, if you get into the ESG side of things, then you've got to expect it to cost a little bit more, because there is more monitoring. There is more to do in these funds in terms of managing, monitoring, and organising them to meet standards. So there's about a 0.4% rise in the cost for ESG investing. So if you think about what that actually means, they've given a good example here, because 0.4 doesn't sound much, does it? But when a market portfolio can be achieved at 0.10 overall, you're looking at a difference of £11,840 if you're talking about £100,000 over 10 years in a kind of 50-50 type portfolio. So a balanced portfolio would cost you nearly 12 grand more to run over that 10-year period than a fully diversified one. So their argument is, if you're investing purely for performance and you want to manage risk to the best, then go fully diversified and spend your 12,000 with a charity that's doing work that you want to support. Do your kind of responsible investing that way. That's an alternative. But if you are going to say, no, I really don't like the idea that my money is supporting things that don't align with my ethics and my values, I only want to be investing in things that are lined up for this, then you must expect to pay a little bit more. And over time, that mounts up to quite a bit. So that's one area, that's the cost area. And the other area I touched on there is the diversity part of it. So if you are going to invest in the whole of the globe, everything in every country, every sector, every currency, then you've got massive diversification. If something goes wrong somewhere, it's a tiny, tiny part of your overall portfolio. But if you start saying, but not that, and not that, and none of that, and that's for America, then the universe of investments is getting smaller and smaller and smaller. And that creates something that we call concentration risk. So that lack of diversification. And the example here I can give you is when Russia invaded Ukraine. So we had a long period of ethical ESG type investing being very popular, and the funds doing very well, and everybody feeling really good about their focus on the next generation and the planet for future generations, and everyone was making money out of doing it. And then all of a sudden, Russia invaded Ukraine. The cost of oil went through the roof because of threats to the pipeline supply line. And Ukraine grows so much of the wheat that the world's bread basket was empty. And all of a sudden, we all started to think, oh, stop the next generation and the planet for them. What about my gas bill this year and the cost of a loaf of bread for me? So, like, our vision came right back to today and risks today. And it flipped overnight. And the people who were invested in ESG type funds saw the value of their funds go down, and the value of things like arms and oil suddenly going up, and they're like, what's going on here? Well, the truth is that it's really hard to know which one's going to outperform the other, but there are systemic risks that are going to affect one portfolio that wouldn't affect another, and they're going to go in cycles. So they might not perform the same at the same time. It doesn't mean one's better than the other, but you do have to accept that you build in systemic risk when you start screening out things that you won't or don't want your money being used to invest in. And it is going to put the cost up a little bit. Having said all that, ESG investing is still open to everybody, can be done very, very safely. When we talk about this narrowing of the investment, there's still more than 10,000 funds in that portfolio that I was just showing you the cost difference on in the ESG portfolio. So you can still be massively well diversified. We do have some other clients, Selina. I was talking to you earlier about the RSPCA. We look after the RSPCA investments for the Thanet branch. And of course, they're very, very hot on screening out animal cruelty. And they don't care that it costs them 1% more to run that portfolio. They just are not getting involved in anything to do with animal cruelty. So we've got a very definite screen there. They accept the cost consequence, and that really matters to them. And another example I was telling you about was the WI, so the Women's Institute for East Kent. And they thought that they wanted to exclude gambling from their portfolio. And I was like, well, how many raffles do you run a year? So you have to be a bit careful, when you start applying these screens, that you don't actually overdo it and get everything sort of lumped in one thing, when really it's more nuanced than that.
Absolutely.
What about performance, Selina? Where do we stand on the difference in performance?
So performance, when it comes to, and again, it's, we talk about performance because that's what we want to get when we are investing. We want to make sure that we are getting a return on our investment. And, the data shows that there is sort of no difference. Ethical investments can perform just as well and sometimes better, and then sometimes not so better than traditional investments especially over the long term period. It's also important to recognize that companies that score well on environmental, social, and governance metrics, they often manage risk better. They want to avoid scandals and are more resilient to regulatory changes. So, for example, funds that have avoided fossil fuels have outperformed at times, especially when oil prices have dropped and climate regulations have tightened. So, ethical investing can, kind of underperform, overperform. I think there is kind of sort of no real difference when it comes to that. And you're probably all wondering, how can I start, my ethical investing journey? And I just have, a few kind of descriptions of ways to do it that I want to go through really quickly. And then Sam is going to kind of finish us off with more descriptions. So, you might take an approach where you are, doing that ESG approach. So, environmental is how a company impacts the planet, whether it's their carbon footprint, pollution, renewable energy use, or it's the social, so how it treats people, employees, suppliers, customers, and communities. And then there's also the governance. How well is it run? Are there opportunities for leadership for, for women, for, diverse candidates, executive pay? Is it fair? Shareholders' rights and transparency. So you can take an ESG approach, which is quite broad. It's not telling you to invest in or avoid any particular companies, but it's still giving you a lens to assess, the risk and responsibilities. And then a more in-depth, or the next kind of step that goes a bit further, is socially responsible investing. So SRI, which is where you are actively excluding companies or industries that don't align with your values. So Sam gave the example of, an RSPCA branch here in East Thanet. So it could be avoiding tobacco, weapons, gambling, steering clear of fossil fuels. And it's more this is my moral compass. This is an ethical belief. So I don't want to support that with my investments. Or it can be impact investing, which is making a difference and also getting a return as well. So the goal is to intentionally invest in companies or projects that create positive social or environmental change and still delivers financial returns. So it could be, investing in microfinance institutions, helping underdeserved communities, or renewable energy startups. So, tackling climate change. So a lot of people into Tesla at the very beginning, or it could be affordable housing developments in low income areas. So it's the most proactive, and it's aiming not just to avoid but to create good. So those are kind of ways of doing it. And Sam, how can you practically kind of get started investing?
Yeah, I think it's important when you go into this to start with defining what matters to you, because you can get very tangled up in a lot of the detail. And to be honest, most of our clients just go, you know what, let's just do what we can for the good guys without making it too risky for me or too expensive. That's they want this kind of light green passive approach. And then some people really don't mind about half the things that the sustainable investment firms are talking about, but there's one or two particular things that really bother them. And if you're going to go down that road, then you're normally, you're putting your costs up a bit because of the screening that's required. But if it matters to you enough, of course, it matters, and it needs to be done. I've just got, I'm going to share this with you because I think this defines it. So define priorities, make sure you know what you're doing and why, and that because you are going to put your cost up, it needs to matter. Let's research funds and strategies. That's where I think we come into our own, because I'm just going to very quickly flip to this page, and it is horrifying. So I'm warning you now. This is a tool that we use. It tells you here there's 1,265 funds on here. And we've got all of this criteria that we can use, loads of it here, to filter through these. And even then, when we get to the ones that meet the criteria, we still then need to transport that information into another system and do a performance review. So everything is on here except performance. And, to me, investments start with performance. There's no point in investing something that's not going to deliver a performance. You might as well just go and spend the money on something locally that matters to you. So, there's a whole kind of process to be gone through here. And I don't really think that it's something that you should be doing on your own. But if you want to try, most of the platforms out there will have filters on that allow you to select. But please make sure when you're doing all that, you end up with something that really can actually give you a real return above inflation. Otherwise, there's no point in doing it in the first place. Be surprised how many times I look at ESG funds and think, yeah, but it's going backwards.
Yeah.
What's the point of this? So start small. So if you're going to have a go, and you're going to, especially if you're going to do it on your own, then perhaps don't throw everything you've got into this to start with. Run a fully globally diversified portfolio, and then choose an ISA pot or a pension pot that you dedicate to ESG investing, and see how the two differ in terms of cost and performance. The performance will be different over different time scales, but watch them on different cycles. You don't have to do everything all from the start if you're not ready. And then stay informed. The idea that this is a one and done choice is a bit naive with any investment. It's a very dynamic environment. So, and with ESG, because it's nascent, because we know that there are standards being written as we speak, indexes being built as we speak, then we know it's going to change. And not all change is for the better either. So it is a growing area of research and data and information. But I do think it's ever more important that those of us who want to make sure that we're supporting the good guys get a sort of a cost-effective way of doing it. And that's what we generally end up recommending for clients who come to us with a particular thing in mind. I know that we've got one person in the audience today who is a very specific investor, and it'll be the animal cruelty stuff. Kay, I see you. That matters massively to her, and there's never been any doubt in her mind. So the fact that it might cost a bit more to achieve that will not bother her. It would bother her far more that, you know, her investments were allowed to support anything that wasn't kind to animals. So if it matters to you, you'll be willing to pay for it. Start small, don't do the research on your own. We're your best financial friends, and we've got kit and tools to do it. And even then we find it really hard, and it's changing all the time. The data's improving, but it's not perfect. So we're doing the best we can to make sure that we get things right for you. Stay informed, stay interested. Selina, do you have any other points that you wanted to add?
No, it's just to stress, you know, like I mentioned earlier, although on the tin it looks like such a simple transition to make, you've had all of your investments in, you know, different considerations. It was previously just all about the returns that you're going to get. Now you're adding on this additional filter, and it can seem really quite simple, but actually there is some complexity to it, just because it is a quite nascent and quite a new change in market. So do bear that in mind if you are kind of investing yourself, or if you're investing through us. Sometimes we can be your best friend in making sure that you are invested in an ethical way. So that's all I would add there.
So we've got a question from Jessica. I don't know, Jessica, whether you wanted to come unmute yourself and actually call this out, or do you just want me to have a go answering it? So you would recommend having a separate ESG portfolio rather than having it as a small percentage within your portfolio. Either way, the thing is that when we look at portfolios, we look at the risk, reward, and time frame scenarios that we're working with. That's the really important part of portfolios to us. So, whether we would be looking at it from that perspective, how we actually then allocate the money to investments in line with that strategy is the next bit. And that's where you could choose an ESG fund amongst your mix, so that you've got some exposure, and you could then see how it does compared to the others. So either way, you could either have it in, one fund as an isolated piece that you compare to the others, or you could have it as a separate investment. I don't mind. I wouldn't suggest either way. It depends on the bigger picture. And I think that's the important thing. The bigger picture is that you are an investor looking for a real return above inflation. The bigger picture is that you're investing over certain timescales. The bigger picture is that you might want your money back on one specific day for one specific reason, or as an income stream starting at a certain time. These things matter much more than the actual asset allocation to an investment. So don't sacrifice the big strategy in favour of a small trend that you're thinking of getting involved with. But if it is part of your overall feeling that you want to move more and more towards this, then you can do it in stages. So you don't have to do it all in one big lump, is what I'm saying. So we can help you manage it either way. Don't forget that with 2,000 funds out there, it's not easy to choose between them, and getting that wrong could cost you quite a lot of money. So I think deferring to experts in this area is probably going to be very valuable to you in the long term. But then I would say that, wouldn't I?
No, Sam, thank you for your advice. Sorry, I finally got off mute. I was having issues with trying to get off mute, but yeah, that's what what I was thinking of was having it as a small percentage, because I've got emerging markets as a small percentage within my portfolio. But what I found, and maybe
Well,
it's
emerging
because
markets is very unlikely to be ethical.
it's a oh really emerging markets.
Yeah, emerging markets are the last place really where the reporting structures, governance is good enough to qualify.
Oh no, I wasn't using emerging markets as part of my ESG.
Oh, right, okay.
It's just part of my portfolio. But I was looking at ETFs as for ESGs, and like you mentioned, you know, they're not. I don't know whether it's the time, like whether Trump is having an effect on this, or you know, the war in Ukraine, or what.
Trump's a small blip in the history of capitalism. Trust me. Honestly, you know, you need to zoom out, because any portfolio that you're doing has got a longer history than Trump has got in premiership.
Power.
So, like, you know, and capitalism will work out how to exploit Trump's regime. So, like, you know, don't get too focused on, and ESG principles should override who's in power. If you have them, you have them. If you don't, you don't. So, you know, that's kind of, yeah, that's how I would do it. Don't think about who's in power in America. Think about whether ESG matters to you as a criteria in your portfolio. And then the time frame that you're doing that portfolio over, and how you're going to expose yourself to assets to deliver over that time frame, including some ESG if that's what you want to do.
Yeah. So right now that's what I was looking at. I was looking for an ESG ETF to fit in as a
ETF, for those who don't know, stands for exchange traded fund.
So that's what I was trying to do. I was trying to get an ESG ETF to fit within my portfolio, rather than do I need to create a whole different portfolio?
Okay, well, do you remember I showed you that fund eco market?
Yes.
There's a selection thing on there called ETF. So you could you could have a look at the ETFs on there and see what's available.
Yeah, great. Thank you, Sam.
You're welcome. Thanks for joining Selina and I today. We hope you found the session useful. You can join Women's Wealth 3 by signing to our Enable membership, and Carolyn put a link in the chat for you to do that. And can I just give you a date for your diary? On Friday the 30th of May, Sifra James, one of our money mentors who's spent her life working for big corporate until she saw the light and became a financial planner for Women's Wealth. She's running a session looking at kind of toxic workplaces. So how to exit a toxic workplace and land on your financial feet. So she's got some great stuff to share with you on that one. And our next Ask the Advisor session is at 7 o'clock in the evening, and that's on the 12th of June. So myself and some of the money mentors will be here taking your burning questions and trying to provide you with some answers. So thank you everybody for your time, and I hope you found it useful.
Thanks, everyone. Take care. Bye.